S Naren joins us, Executive Director and CIO with ICICI Prudential AMC. Let's talk markets, interest rates, what investments they are doing, and where are they finding value in the market. Naren, is it an optical illusion? I can only see white hair.
I don't know.
Is it stress
White
or is
hair
it
is not
age?
a
Is it
bad
wisdom?
thing
Kya ho
from
raha
an
hai, bhai?
investment. My guru Howard Marks says there are no old bold investors. There are either old investors or bold investors. So I think old is not a bad thing. So that's why I don't think I care about it.
So I will call it wisdom. I will not call it age. Okay. Let's use your wisdom so that our viewers can benefit from him. What is happening in the markets? Why there are so many moving parts?
See, actually, no. On the eve of Diwali, we had to give an interview where we told people that equity is not bank FD. Because the problem is there was a period of time from 2020 to 24 where people have thought that equity market is bank FD. At least after this correction, no longer do people think that equity risk is equal to bank FD risk. So I think that's necessary. And so that I think, but the reality is that global funds are the main reasons for this correction. There have been two times they have sold, once in 2021-22, and the second time in the last 30 to 45 days. And both of them, they have sold for reasons which are international. I think strong dollar, they wanted to take the money back to US, etc. So it has got less to do with Indian macro fundamentals or something like that. And because if you look at it, small cap or mid cap haven't corrected in India significantly, mainly because they don't own it. So the selling has been completely in large caps, both in 2021, 22, and now. So I don't think there is anything big to worry about, because subsequently at some point of time in the next 1 year they will come back and buy, because it is not that strong dollar is permanent. You have a situation where US has high fiscal deficit, high current account deficit. So in that kind of a situation, you're not going to have dollar continuously only appreciating. So at a time when they start depreciating, you will see inflows, and that time the inflows will again come into large caps. So that's why we don't worry too much about it. But if you're a trader, you have to worry about it. But if you're an investor, you have to worry less about these kind of corrections that you've seen in the last 2 months.
When we spoke last, that was before Dashera on the same forum, you were of the view that it's hard to get bullish on the market because of valuations. From there to now, there has been a 10% shave off in large cap stocks, a 15% shave off at least in mid cap stocks, and a 25% shave off in small and mid cap stocks. Looking at the parts which you just mentioned, macro, interest rates, earnings, etc., are valuations still rich, or are they looking reasonable?
The valuations are still rich in mid cap and small cap. I don't think the small cap index has fallen 25%. Maybe some stocks have fallen 25%. Neither has the mid cap index fallen 15% across the board. Some mid cap stocks have fallen 25, 15%. So our view is that large caps are more reasonable at this point of time compared to mid cap and small cap. Is the market mouth-watering and saying that you have to put a thumping the table buy at this point of time? The answer is no. But in our framework, when flows are very negative, you're supposed to be a bit positive. And that is our framework. And flows have been very negative from FIS. I don't think you've seen this kind of 10, 12 billion, $15 billion selling. We've seen it very few times. We've seen it in 2008. We've seen it in 2020. We've seen it now. So I believe that itself is a reason to be a bit positive at this point of time. And that is completely on the large cap side. But market valuations are not super attractive or something at this point of time. Clearly not.
Okay. Then I move to the second part, Naren, which is this entire strength in dollar Trump 2.0 trade. There are assumptions based on the last regime of Donald Trump that a Republican administration led by President-elect Donald Trump means higher tariffs, more trade wars, and more gravity of manufacturing or supply chain moving away from China. Do you think market assumptions are right and one should place these changes in portfolio planning or investment planning for next 4 or 5 years? Because whatever US will do will surely will have an impact on assets, financial, assets and supply chains.
See, you know that on a continuing basis, Donald Trump is known to negotiate. He will keep negotiating and doing things in a way that involves trade wars, but at the same time, he'll negotiate. So I think broadly, if you ask me, you can't ignore the fact that US has very high trade deficits, and you can't ignore the fact that US has high current account deficits. And in the first regime of Donald Trump, he had the benefit of zero interest rates to fund his fiscal deficit. That is no longer there. Let's accept that you're not going to go back to zero interest rates because inflation has set in US. It's not going to go back to zero interest rates. So that is a problem that US is having when you have 100% fiscal, global government debt to GDP, and you no longer have 0% interest rates. You have a borrowing cost for all your government debt. And unlike India, they have not been used to high interest rates. So they're going to suffer because of that count. So I think everyone equates 2016 to 20 with Trump 2024 to 28. I think 2024 to 28, the US economy has to be handled much more carefully because 2016 to 20 was very easy. You had a situation where the starting point, everything was very comfortable. And if you had debt and if you were trying to finance it at 0%, it was too easy for Donald Trump in the first regime. But this time it is not going to be the same. So I think people think that it will be very easy. It is not going to be easy. It is going to be a situation where the US has to live within its means more. And that would mean, yes, trade wars, but then somewhere they have to handle their fiscal deficit as well. Otherwise, interest rates can go out of control. US is not like UK. UK is a much weaker economy, but you know what happened to UK for a few weeks about a few years back. So I think it's very important that US also has to handle its macro very carefully, and that they will do it, I'm sure, eventually, because it's a very flexible economy. But they don't have the flexibility that they had in 2016. So I think all this is good for India in the medium term. The problem with India has only been that equity valuations have been very high. And even after this correction, they are not mouth-watering. And that, although large caps are definitely more attractive than mid cap and small cap.
Naren, you are a top-down guy, and I just want to bring this point for our viewers that over the years I've interacted with Naren. When he's investing, he looks at interest rates, macros, country risk, fiscal deficit, balance of payment when he typically is making his investment calls. So Naren, there is another macro trade which started 3 months ago and perhaps has ended before everybody started talking about it. The long-lived China trade. Is that trade over?
From a contrarian point of view, I also like the trade, but it seems to be over so quickly. See, the challenge is China at the end of the day is not a democracy. In a democracy, I learned from my Russia experience that, when you don't have a democracy, there are challenges. Having said that, purely on valuations, China is really cheap. But do you understand the economy? The answer is no. But on valuations, they are cheap. Does it make sense to invest big money? Answer is no, because you don't know what is there in all that. But what we learned from 2012, 13, 14, if all your debt is domestic, and if you have current account surplus, which is the situation in China, there are a lot of flexibilities that China has. Overnight, you can do a lot of things. You're not dependent on the rest of the world to fund you. You have a current account surplus and a huge foreign exchange reserve. So you can do a lot of things. It is just that the Chinese government has decided that this is what we need to do, and that's why they are continuing to do what they want to do. Can they give a big consumption bazooka? They can, because they have the capability to do it. It's not that they are dependent on the rest of the world to fund them. So that is the kind of situation. But India is a much more stable economy. It has much more, the debt part of the economy across the value chain is very comfortable. corporate debt is comfortable, government debt is comfortable, household debt is going up but very comfortable. So I would say we are in a much better position from a macro point of view.
Can we come back to India, Naren, now? We've discussed global macros, Trump. Let's get S Naren's view on India now. One very big concern which has surfaced up after the last quarter numbers is that earnings are slowing down, demand is slowing down. And that is a real deal, Naren. Auto sales, FMCG sales, whichever way I look at the high frequency data point, even on government spending, they are indicating that the economy is slowing down, something which markets were not prepared for. What is your view on demand and earnings now?
See, I'm not yet willing to throw in the towel there because, see, you have to remember that you had elections in May and you had a very good monsoon this year compared to last year. And you had a festive season, which you have to handle because end of the day, if you look at October auto numbers, they were very good. So I think, you can throw in the towel after, maybe December result or something like that. And it's too early to throw in the towel and say that the capex also has not been spent by the government of India because of the fact that you had a situation where the elections did delay some of the expenditure by the government of India. Look at the way fiscal deficit is of central government. It's been fantastically low. So I would say that it's yet too early to throw in the towel and say that the economy is slowing down. The challenges is only coming, in my opinion, from valuations and not yet from the economy. Because see, people used to say credit growth is too high, deposit growth is so slow. Look at this year, deposit growth has picked up against credit growth, so that issue is resolved. So I would still not say that there is a serious macroeconomic concern on growth. There is a clear problem that some sectors like FMCG, which is catering to a larger part of the population, have been struggling for years. And we hope that those kind of sectors start to do better. But overall, I don't think there is such a serious problem on economy. I think earnings is certainly was a problem in the September quarter. And I think in the December quarter, things will be slightly better. But the problem is that if you look at most small cap and mid cap, you're giving them 60, 70, 80 PE. Is it justified? No. But the reason they are being given 60, 70, 80 PE is because there is continuous inflow into small and mid cap funds. And due to that, the funds buy at 60, 70, 80 PE. And that is the challenge, if you ask me, is the problem rather than the economy. I don't think economy is the problem. And I don't think earnings is as serious a problem. If you look at banking earnings, they've been very, very good. And select sectors of the economy are still doing okay. IT did reasonably well. Pharma did reasonably well. So, and some of the, I would say festive oriented sectors did pretty badly. And let's see what happens in the December quarter.
So Naren, there was a time when you said, look, I will come out of the comfort of banks and buy into utilities. Today, utilities are trading at price to book which are higher than financials. Market, I just want to bring this point out for our viewers that Naren always believes that its market is always like a pendulum. Mean reversion is the biggest truism in the market. So Naren, where do you think the mean has reverted on the upside and where do you think the mean will now revert lower? And similarly, where do you think the mean has gone lower and it has to revert to normal?
Actually, there are very few things where markets are dirt cheap. Clearly, mega caps are relatively very attractive compared to small cap and mid cap. On absolute basis, they are okay, but they're not dirt cheap at this point of time. Will there be a period where FIs will buy in the next 1 year, which will make mega caps and large caps do much better than small cap and mid cap? I think so. When it will be? When dollar strength disappears. And that will happen. But I would say that the areas where things are still reasonable is banks at this point of time. Clearly, I would say then, many of the consumption sectors have done badly for a long period of time. The valuations, even after doing badly for a long period of time, is not dirt cheap, but they can give relatively better returns maybe. And that is where we are. The areas where I would say people have to be very careful are these loss-making companies where, people give valuations on what basis you have to see. And that is where I think investors have to be very careful. That's why, everyone is not tailor-made to do direct equity investing. So in the 2020 to 24 era, too many people have done direct equity investing. And the last 3 months would have shown the risks of direct equity investing over mutual fund investing. And because many of them would have bought stocks where there were no earnings, but you would have seen that. And still, that area, I don't think the last word is out. Even today, there are a lot of stocks without earnings which are trading well. So I think it is important to do to invest through maybe index fund, ETFs, or direct or mutual funds, because I think everyone is not the right route is not derivatives or direct equity investing, because you will end up buying some lemons. And when you buy those lemons, you will realize it much later that they were lemons. And that is my biggest worry actually for investors, because I was a stockbroker in the 90s era, and that's what we try in our mutual fund to actually recommend asset allocation because it's much safer. Take today, as of yesterday, there was only 19% large cap index Nifty had given. So, think about it, 19 is not a very high number. Intuitively, people think market has given huge returns in the last 1 year and 3 year. It is not so high. So that's why I think, even hybrid funds or asset allocation models deliver good experience to investors.
I'm coming to specifics of your NFO and some of the NFOs which you've just launched, but I just want to wrap before I move to specifics of the new NFO and low volatility concept. And I'm going to divide this question into 2 or 3 parts, Naren. For next 2 or 3 years, where do you think this market is in for incremental surprise, and where do you think this market is in for a big negative hit because of the valuation versus earnings interplay?
I think clearly some of the companies will show a negative surprise where the implied growth assumptions have been too high. And in my opinion, some of the older companies which have been there for a long period of time, where people have a long history, in those companies, people can't estimate too much. So consequently, what happens is there, this kind of a negative surprise is much lower. So I believe that those are the companies we believe we should focus on. And clearly, in past cycles, banking has always been high beta, but you look at the last 45 days, they have not been high beta. Look at it, normally small cap and mid cap have been high beta, but in the last 3 years, small cap and mid cap have been low beta, but I don't think it will last. So I would say that you have to be more careful in IPO companies, you have to be more careful in QIP companies, you have to be more careful in small cap, you have to be more careful in mid cap. And you have to be less careful in quality companies. You have to be less careful in themes which have failed in the last 3 to 5 years. And you have to be less careful in mega caps where the governance structures and various things have been much better. And that is how we look at it.
And Naren, last but one question on the markets, which is that there are a lot of incremental themes which suddenly markets are excited about. EV, energy transition, solar. Where are some of these so-called energy transition themes headed, and who will be the eventual winner? One side you've got the classics like NTPC, and on the other side you've got companies which essentially are in solar and alternate powers like wind, which have seen a series of IPOs and NFOs.
See, what we learned from the 2021-22 experiences when those new age companies came, we were very, very careful. I used to tell people that we used to work with some of the younger colleagues in my company, and we actually stayed away initially. And then later, actually, as they corrected, we found that they were interesting companies, and wherever we found them interesting. We actually bought them after a meaningful correction in 2022-23. Now also, if you look at many of the solar companies or many of those kind of companies, I believe that again, I would say either we have very small position or we have stayed away. And we think that again, after a year or two, you will find that some of these companies are worth taking big positions and some of these companies are not worth taking positions. And we will look at it because end of the day, whenever these, which company will become an NVIDIA and which company will go down the tube, we don't know. I mean, I'm talking NVIDIA from an India concept, not from a global concept. So what I'm saying is, therefore, what happens is we have to do some work and we like these 9 months after listing, 1 year after listing, how do they behave? How do they communicate? How do they deliver? What are they doing after raising money? That period is much more interesting for us than just after listing. And that's the phase where we have found very, very interesting situations. Like there was a stock which got listed at 1,500. It came down to 1,500, 500. And at 500 onwards, we started looking at that stock, a new age company. And we had a very good investing experience. And I would say that is the kind of model that we have found more interesting instead of saying this is the new area. So we'll get in all in. That doesn't work because at that point of time you get involved, interested in all the companies, and many of those companies have promoters who don't understand the value of minority investors, who don't understand the value of corporate governance, who don't even understand what listing is.
So let's talk about your new NFO, and it is Equity Minimum Variance Fund. What is the concept here?
See, basically, we were very keen that we should have a fund, given the way markets are at this point of time, a fund which is primarily invested in Nifty stocks. And so the stocks are basically from the Nifty universe, and the goal is to invest in risk-adjusted returns and lower volatility stocks, and do it in an active way. On the non-active way, there are numerous index fund and ETFs at this point of time. We thought that given the way mega caps and large caps have underperformed mid cap and small cap, and given the way, the passive funds in this category have actually collected huge AUM, we thought that there is a case for active investing in this framework. And, as a company, what ICICI believes is you have to focus on these kind of areas which are lower risk, and hopefully they are lower risk. And we believe that those kind of areas are the ones which we think are interesting for investors to invest in. Because what happens is if investors lose less money, as we have seen in the hybrid category, investors feel happier and they actually believe much more in mutual funds and ICICI. And that is with that same framework, we have looked for stocks also. And that to here, the primary investing universe is the Nifty. And this is the only fund in our entire universe where Nifty is the entire universe of this fund. And we thought it's interesting, and the timing of the fund is interesting when mega caps have done so badly against small cap and mid cap. And that too after such a savage selling from FIIs over the last 45 days. So we thought from all those sense, it looked interesting for us to launch such a fund. So we are happy to launch such a fund at this point of time. We do believe that while the dollar continues to keep on appreciating, the large caps will continue to be volatile relative to mid cap and small cap. But when we take a 3 to 5 year view, large caps are always lower volatile, and we expect that to be a good timing from that point of view. And over the years, we have tried our best to launch categories which we think are interesting, and try our best to manage the money in the way that we can, with its own risks in a market from a market point of view. This is where we are.
Well, Naren, always fantastic. Always fantastic to have you on ET Now. Thank you for joining us. And the white hair is wisdom. It's not age. That's what I'll say again.
Thank you.
If you like this video, then like, share and subscribe to ET Now.